If you are a green card holder and you own a business in the United States, there is a claim moving fast online right now that could affect your financing plans. That SBA loans will be denied unless a business is 100% owned by U.S. citizens or U.S. nationals with a March 1, 2026 deadline. And the way the claim is framed is what makes people panic. Even 1% ownership by a lawful permanent resident could supposedly trigger an automatic denial. Here is what you will know by the end of this briefing. 1. What this claim actually says in plain English and what parts you should verify before you change anything in your company. 2. Who would be affected if this rule is real and enforced the way it is being described, and who would not? And 3. A practical, calm checklist for what to do now if you have an SBA loan in progress, you are planning to apply, or you are considering restructuring ownership. Now, I want to be very careful and very clear. I am not the SBA. I am not your lender, and I cannot confirm policy memos just because they are going viral. The input for this video includes specific assertions, including a date of February 3, 2026, and an effective deadline of March 1, 2026. Treat those as reported claims until you verify them directly with your SBA lender and official SBA guidance. Here is the part most people miss. Even when a policy change is real, what matters is how it is defined, how it is implemented by lenders, and what is grandfathered. A single sentence can completely change the outcome for your business. So first, what changed, in plain terms, according to the claim? The claim is that starting March 1, 2026, SBA will not approve certain SBA loans for a business unless the business is 100% owned by U.S. citizens or U.S. nationals. Not 51%, not majority, not controlling interest. 100%. If that is accurate, it is a very high bar, because it would exclude anyone who is a lawful permanent resident, anyone on a work visa, anyone with refugee or asylee status, many mixed nationality ownership groups, and even some U.S.-based funds and holding companies that have any non-citizen ownership in the chain. And the second part of the claim is the so-called 1% trap. That is the idea that even a very small ownership interest held by a green card holder would block eligibility for the entire business, because the rule is not about control. It is about the presence of any non-citizen ownership. Bridge hook. This is where people get denied in real life, even under normal rules, because the SBA and the lender look at both direct ownership and indirect ownership. Direct ownership is simple. Your name is on the cap table, the stock ledger, the membership interest schedule, the partnership agreement. You own X%. Indirect ownership is the chain. Example. You do not own the operating company directly. You own 50% of a holding LLC, and that holding LLC owns 60% of the operating company. You indirectly own 30% of the operating company. Indirect ownership can also flow through trusts, family entities, and even multiple layers of companies. If a policy truly requires 100% U.S. citizen ownership, the concept of indirect ownership becomes the entire game, because lenders will ask, who ultimately owns any piece of this borrower, and are they a U.S. citizen or national? Myth versus reality number 1. Myth. If you have a green card, you are treated the same as a citizen for all government-backed programs. Reality. A green card is a very strong status, but it is not citizenship, and different programs have different eligibility rules. Some treat lawful permanent residents similarly to citizens, some do not, and some rules can change. Now, who would be affected if this reported change is accurate and applied broadly? Bucket 1. Green card holders who directly own any share of a business that wants an SBA 7A loan or an SBA 504 loan. Even if you own 1%, even if you are not the managing member, even if you do not sign the loan personally, if ownership is part of eligibility, that ownership could matter. Bucket 2. Mixed ownership businesses where a U.S. citizen partner owns most of the business, but a lawful permanent resident owns a minority interest. Under a 100% rule, minority interest would not save the deal. Bucket 3. Businesses owned by another company, where the ownership chain includes a green card holder. You may think you are not an owner because your name is not on the operating company. But if you own part of the parent or a holding entity, it could still count. Bucket 4. Planned acquisitions. If you are buying a business using SBA financing and your new company would be partially owned by you as a green card holder, the deal could be impacted, not only your application. Now, who might not be affected, depending on how the SBA defines the change. Bucket A. Businesses that are 100% owned by U.S. citizens or U.S. nationals, with clean documentation and no indirect non-citizen ownership. Bucket B. Businesses that are not using SBA 7A or SBA 504 loans at all. Conventional bank loans, credit unions, equipment financing, revenue-based financing, and some local or state programs can have entirely different rules. Bucket C. Situations where the green card holder is not an owner but is an employee or contractor. Being the CEO does not automatically mean you are an owner. Eligibility rules usually focus on ownership, control, and the borrower entity. Important nuance. I am using general concepts. The exact categories depend on the actual program rules and any new guidance. That is why verification matters. Bridge hook. Two groups are at highest risk of being blindsided. 1. People mid-deal with a lender who suddenly requests an ownership chart and citizenship documentation. 2. People who rush to restructure ownership in a way that creates tax problems, immigration complications, or future disputes with partners. Let us talk about why this might be happening, because it helps you predict what could happen next. When agencies tighten eligibility, it is often about risk management, fraud prevention, political pressure, or program integrity reviews. SBA programs rely on lenders, and lenders rely on rules that are easy to apply. A bright-line standard like 100% citizen ownership is blunt, but it is simple to enforce. Another possible driver is compliance and verification. Verifying lawful permanent resident status can be straightforward, but programs sometimes prefer citizenship because it is viewed as easier to document consistently across all owners, especially when ownership is layered. And a third factor is timing. When there is a proposed or reported change with a future effective date, it can create a surge. People rush to apply before the deadline. Lenders get overloaded, processing slows, and the most common outcome is that the last-minute applications are the ones that do not close in time. Now let us get practical. What happens to pending SBA loan applications if this change is real? There are usually 3 stages where you can get stuck. Stage 1. Pre-qualification or term sheet. You are talking to a lender, sending basic financials, and they are deciding if you fit. If eligibility changes during this stage, the lender may stop the file or redirect you to a non-SBA product. Stage 2. Underwriting and SBA submission. This is where ownership documentation is scrutinized. If a new eligibility rule applies, this is where the denial could happen, because the file must meet current requirements at the time of approval. Stage 3. Closing. Even if you were approved earlier, closing conditions can require updated certifications. A lot of people assume approval means done, but if closing happens after an effective date, some programs treat you as subject to the new rules. You need to ask the lender exactly which date controls in your specific case. Myth versus reality number 2. Myth. If you just apply before the deadline, you are safe. Reality. For most financing, the key date is not when you start the application. It is when the loan is approved or when it closes, and that depends on the program and the lender. Do not assume. Confirm. Next, are existing SBA loans safe? In many programs, existing loans are not retroactively canceled just because eligibility rules change for new approvals. Servicing rules often allow the loan to continue as long as you remain in compliance with your loan documents. But here is the part most people miss. Even if your existing loan is safe, certain changes can trigger lender review. For example, a change in ownership, a major refinancing, a loan modification, a change of control, or adding a new guarantor could bring the file back under a new eligibility lens. So do not panic sell your business because you heard a rumor. but also do not casually change ownership percentages or restructure without understanding how your lender and the SBA treat those events. Example scenario number 1. This is a composite example, not a real person. Maria is a green card holder who owns 30% of a construction company with 2 U.S. citizen partners. They are in the middle of an SBA 7A loan to buy equipment and stabilize cash flow. They think the citizens owning 70% will protect them. If a 100% citizen ownership rule is implemented as described, Maria is not just a minority owner, she is a disqualifying owner. Their options become: try to close before the effective date if allowed, switch to a non-SBA product, or restructure ownership. And each option has trade-offs. Example scenario number 2. Composite example. Ahmed is a green card holder and the sole owner of a small manufacturing business. He already has an SBA 504 loan on a building. He hears the claim and thinks he will lose the building. The more realistic risk is not that the existing loan disappears overnight. The risk is that if he needs a major modification, additional SBA financing, or a second SBA loan, he could be blocked. His next step is to read his loan documents, talk to the servicing lender, and plan ahead. Bridge hook. Now let us talk about the most dangerous option people jump to: ownership restructuring. If you are considering shifting ownership to a U.S. citizen to meet a 100% requirement, you need to think in 3 directions at the same time: legal ownership, tax consequences, and control and trust. Legal ownership. If you transfer equity, you may be giving up actual rights. It is not just paperwork. Even if you have side agreements, you could be creating disputes later. Taxes. Transferring equity can trigger gift tax issues, capital gains issues, valuation issues, and state-level filings. If you rush this in panic, you can create a tax bill that is bigger than the loan benefit. Control. If you need the business to remain under your operational control for licensing, contracts, or simply business reality, shifting ownership could affect banking, bonding, and vendor relationships. So here is a safer way to think about it. Do not start with what you want the ownership chart to look like. Start with what your lender requires, what the SBA requires, and what your business cannot afford to lose. Now the big question: what should you do right now, before March 1st, 2026, if you are a green card holder business owner? I am going to give you a practical, do this and avoid this checklist. This is general information, not legal or financial advice. Do this. 1. Verify the claim with primary sources. Call your SBA lender or a lender you trust and ask, what are the current SBA eligibility rules regarding lawful permanent residence, and have you received any guidance about a 100% citizen ownership requirement effective March 1st, 2026? Ask them to point you to the official SBA document they are using. 2. Map your ownership, including indirect ownership. Create a simple ownership chart showing every entity and every individual who owns any percentage and the percentage at each layer. Lenders love clean charts. Confusion creates delays. 3. Gather status documentation in an organized way. If you are a citizen, that might be a passport. If you are a lawful permanent resident, that might be your green card. The key is to have consistent documentation for every owner, because missing documents stall files. 4. If you have a pending SBA application, ask for the controlling date. Ask, is eligibility determined at application, SBA approval, authorization, or closing? Then ask what the realistic timeline is to reach that date. 5. Build a Plan B financing path now, not later. Talk to your bank about a conventional term loan, an equipment loan, a line of credit, or other alternatives so you are not forced into expensive options at the last second. Avoid this. 1. Avoid transferring ownership in a rush just to hit a deadline without understanding taxes and enforceability. 2. Avoid hiding ownership. Trying to conceal an owner or misstate citizenship status is a fast way to get denied and could create much bigger problems. 3. Avoid assuming your lawyer, accountant, and lender are all on the same page. They are different roles. You want coordinated advice. 4. Avoid signing purchase agreements that depend on SBA financing without a backup financing clause or a clear timeline. If the loan does not close, you could lose deposits or face penalties. Myth versus reality number 3. Myth: if SBA is not available, there are no good options. Reality: SBA is often the most affordable and flexible for many small businesses, but it is not the only path. The best alternative depends on your cash flow, collateral, industry, and the purpose of the loan. So what are realistic alternatives if SBA access is reduced or eliminated for green card holders the way the claim suggests? Alternative 1. Conventional bank financing. It may require stronger cash flow, more collateral, and sometimes a shorter term than SBA, but many borrowers qualify, especially with strong financials and a clear use of funds. Alternative 2. Mission-based or community lenders. Examples include CDFIs and local development programs. Eligibility varies widely, and some may focus on underserved entrepreneurs. You still need to verify citizenship or residency requirements program by program. Alternative 3. Private lending options. This can include equipment financing, invoice factoring, or other structures. Costs can be higher, so the key is to compare the true annual cost and the flexibility of repayment. Bridge hook. A small detail changes everything here, and it is this: the goal is not just to get money. The goal is to get money on terms that do not break your business. Now, what should you watch next? First, watch for official SBA guidance updates that clarify eligibility definitions, such as what counts as a U.S. national, whether lawful permanent residents are included or excluded, and whether any transition or grandfathering rules exist for applications already in the pipeline. Second, watch lender behavior. Often the earliest sign of a real change is not a press release. It is lenders quietly adding new documentation requirements, changing their checklists, or pausing certain borrower types. Third, watch for delays. If everyone rushes to beat a deadline, the bottleneck can move from eligibility to processing time. Your best move is to start early, with clean documentation. Fourth, watch for misinformation. Viral clips often compress a complicated rule into a scary sentence. If you see absolute claims like all green card holders are banned from all SBA programs, treat that as a red flag until verified. Now, let us bring this home with a calm recap. Number 1. The claim is that SBA 7A and 504 loans will require 100% U.S. citizen or national ownership starting March 1, 2026, and that even small non-citizen ownership could trigger denial. Number 2. If true, the people most exposed are green card holders with any ownership stake, and mixed ownership companies where a lawful permanent resident owns any percentage, including through indirect ownership. Number 3. Do not assume applying before a deadline protects you. Ask your lender what date controls: application, approval, or closing. Number 4. Do not rush into ownership restructuring. It can create tax issues, control issues, and long-term disputes. Coordinate with qualified professionals. Number 5. Build your Plan B now. Conventional loans, community lenders, and other financing can keep your business moving even if SBA rules tighten. Most importantly, do not panic. Your best advantage is time and clean information. Verify the facts with official sources and your lender, then make a plan. If you want more explainers like this that break down policy changes in plain English, subscribe and turn on notifications so you do not miss the next update. And if you are comfortable sharing, comment your situation in general terms like pending SBA application, planning to buy a business, or already have an SBA loan, and I will make follow-up videos covering the most common scenarios.